would have a much better economy if that happened.
Ken, you seem to be more in favor of monetary stimulus. What would that do to inflation?
Well, to put it bluntly, I favor having more inflationary monetary policy, and we can get into a technical discussion of exactly what the government needs to do. Housing prices have fallen, but they're also sticky downwards. And again, if you have inflation, that's a way of adjusting the real value of a house, its value relative to other things, without having to have the price come down. And last but not least, you want to drive down so-called real interest rates, the interest rate minus the expectations of inflation. You want to make that very, very low to encourage people to do things with their money, to spend it, to invest. Right now, everyone's very fearful and cautious, and they need to be pressed. And when interest rates start coming down to where they are, towards zero, there's no other way to make the inflation-adjusted interest rate go further down without creating inflation. And I certainly believe central banks can do this. They've just tiptoed towards this at the moment. They feel that, well, the economy may be doing terribly, but at least inflation is low. Let's not jeopardize the one thing we have. And I would say we have a once-in-75-year crisis, a once-in-75-year recession. It's time to spend a little bit of your credibility.
We are heading for a short break now, but we continue our chat on the current situation in America and its impact on India and financial markets when we return. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. And the big question that we're asking today is whether the world's largest economy, the U.S., will recover anytime soon. Ken Rogoff of Harvard University and John Taylor of Stanford University are still in conversation with us. John, let me start with you. The Taylor rule on interest rates is taught to every student learning economics. What is your view on interest rates in the U.S. and the impact that they are having on emerging economies? Do you still believe U.S. rates are too low, as they have fueled asset price inflation in emerging economies?
I think they could be slightly higher, but I wouldn't go there right away because the expectations that they'll stay low are so strong at this point. It needs to be done in a very gradual way. One of the most important things about monetary policy is not to shock the economy, not to cause unpredictability. So they could come higher. I think the main problem now is all these other things the Fed is doing, the quantitative easing. But down the road, the lower interest rates are a problem if they continued at this level. And with respect to emerging markets, I think it definitely has made monetary policy more difficult in emerging markets. Now, there was a large commodity boom in the last few years. That's diminishing to some extent. You're seeing slowdowns in various emerging markets. In a way, that's the result of, I think, too easy policy that was effectively encouraged by the very low interest rates in the U.S. and in Europe.
If we had to apply your Taylor rule specifically to India, what would you say interest rates in India should be?
Well, interest rates in India, I think, were too low for a while. I think they're basically trying to make an adjustment now. The inflation rate has picked up, and the central bank needs to worry about that. With respect to this precise level they are right now, I'll leave that up to the central bank. But I think more generally in emerging markets, again, what had happened with the very low rates in the last, say, 2 years, that caused rates to be too low in emerging markets, whether it's India, Brazil, Turkey, China. And now they're realizing that the inflation that was caused by that has to be dealt with. And I hope it's not painful, but I think that's one of the concerns I would have about India and the other emerging markets at this point.
And Ken, if I may also ask you about India, what do you think of RBI's policy of targeting inflation at the expense of growth in the short term?
Well, I wouldn't accuse the Central Bank of India of worrying too much about inflation. I think they've actually been very flexible and let it rise quite a bit in many circumstances. India's broader problem is reform fatigue, that in recent years, when a big reform has been proposed, it's gotten pulled back. And I think that's going to challenge India's growth potential going forward, that India has managed to grow remarkably well in recent years with still getting benefits from reforms that were made in the 1990s, really. But now there needs to be another generation if India is going to continue growing at 8 and 10%, which it should. It really should for a very long time.
And since you have talked about debt in America, what risk does high debt in India pose to its growth?
On the debt problem in India, there's tremendous financial repression in India and China. You can't get money in and out of the country as freely as elsewhere. There are all kinds of limitations on financial firms. This allows the government to have more debt at a lower interest rate than it would otherwise, but I think this hurts growth. You clearly don't want to go to the Ireland extreme of financial liberalization, but I don't think India is anywhere near on the wrong side of that curve yet. And the government debt is an obstacle because as you liberalize the financial markets, it is going to raise interest rates. You see that the government pays. You see that all over the world. So bringing down the debt ratio in India is not having any immediate reward, but it allows the possibility of more financial liberalization later on that will help boost growth.
Let's shift focus back to the U.S. economy. John, even if the policy measures you suggested are put in place, can U.S. economic growth really go up from 2% to 4%?
History tells us that. Economics tells us that. Yes, I believe it would occur surprisingly quickly. You never know, it's hard to predict, but I believe it would occur surprisingly quickly if this just great cloud of uncertainty about policy was removed and people could say, oh, America has taken care of its exploding debt. Oh, America has taken care of this massive increase in regulations. The future looks better. Firms are sitting on trillions of dollars of cash. They're holding back because they don't know what's going to happen. They're holding back because they're concerned about big tax increases. So yes, I think it would be a tremendous boom. I don't know exactly when it would occur, but yet we could absolutely get twice as high a rate of growth.
You know financial markets like monetary stimulus and bailouts, and you're opposed to ad hoc measures. What would you say to market participants?
Yeah, you know, things like quantitative easing or bailouts become a bit of an addiction. The Federal Reserve is now being called on to do quantitative easings and other things frequently by people in the financial markets because they feel it has an effect, they like the idea, but the Fed has to be concerned about the whole economy, that high unemployment rate, which is so devastating to so many people. So the most important thing is to get what's right in the overall economy. The markets will be fine if we do that, but not try to be whiplashed back and forth by market sentiment about whether there should be another quantitative easing. I think this is becoming realized now. They've seen that you can maybe have a short-term impact on the markets, but it withers away, and it's withering away more and more quickly with each of these innovations. So focus on the whole economy, not just on the markets. Obviously, traders are going to like specific interventions. They can make money on those, but you got to think more broadly.
Ken, one final question for you on economic growth in the U.S. There are so many estimates on when the U.S. will come out of a recession. Based on your work, what timeline would you be looking at for a recovery?
You know, these things don't come around that often that you can know what the future brings. So from that perspective, it's hard to predict. But if you look at my work with Carmen Reinhart, you certainly see that the aftermath of a typical deep financial crisis takes 4.5, 5 years just to hit bottom, much less feel normal again. So we're very much on a fairly typical path. Of course, policy matters, historical circumstances matter, and there are lots of things that governments can do. But I don't think there's a magic bullet out of these. I don't believe, as some do, that if you just spend a lot more money by the government, suddenly we jumpstart the recovery and everything would be fine. I've talked about having higher inflation. That's not going to solve all the problems. This is one where we talked about structural reform in India. We need structural reform in the United States, governance and structural reform in Europe, and that's the way out. And that's not a very easy message to deliver, but I think that's the most healthy way forward.
And finally, John, the question of the day on everyone's mind is whether the U.S. can lead this economic recovery despite the problems in the rest of the world. Should financial markets be looking to the U.S. for leadership?
I think a slow growth America can't lead the world. If we get back to the robust recoveries like we've had in every single expansion in the U.S. before, we can exercise that kind of leadership, and I think it would be beneficial to the world. But we're not going to do it unless we change our policies, unless we get to the kind of policies that worked so well in the 80s and 90s. We don't have to go back that far in our history to see the kind of policies that worked well. If we get back to those, the world is different, of course. You can't do it exactly the same. But back to those principles, I call them the first principles, the U.S. could be growing much more rapidly and our unemployment rate could be coming down.
Thanks so much for that, Ken and John.
Thank you.
So things are not as bad as the Great Depression for the U.S., but the economy could take a long time to recover. Tanveer joins us to put the important U.S. data points into perspective. Tanveer, where do things stand today?
Well, the data doesn't seem very encouraging, Punita, over the next 2 years. It seems like the U.S. will continue to be in a low inflation, low growth sort of an environment into 2012 and 2013. Some ease in unemployment numbers could come by, but sustainability on that would be a bit of a question mark. The important aspect that everybody's watching out for is the debt to GDP number. It was about 68% in 2008. Now it's 100% plus. By the end of 2012, we're looking at a number of 106%. And by the end of 2013, the estimates are talking about 110%. So that makes the economy in the U.S. extremely vulnerable and risky. In fact, the debt to GDP number is only second to that of Japan. So there are comparisons being drawn about where the U.S. is really headed from here. So that's the economic impact. The stimulus measures, of course, have made the market very risky. So if we just take a look at the graph that will come up on your screens, over two periods in the last 4 years, between March 2010 and August 2010, as well as June 2011 and September 2011, the highlighted periods on the graph, in the absence of stimulus, the NYMEX crude and the S&P 500 have actually faltered. There's a falling trend line there. So that just reflects how the market is very attached to any sort of stimulus announcement and reacts accordingly. If we just also take a look at some of the brokerage estimates, key brokerage estimates running in the market over 2012 expected close on S&P 500, whether it's Goldman Sachs, Morgan Stanley, JP Morgan, the average runs between 1167 to about 1500, with the mean working out to be about 1360. So you're not really expecting too much upside. There is likely to be some volatility over the next 6 months. And that brings me to my question for you, Punita, and that's, how are you viewing the U.S. situation? Because the data clearly is highlighting a fair amount of negativity.
Right, right. I mean, I think, Tanveer, the data that you presented is grim, but I think slightly the things are getting better. So if you look at the stock market, it's up about 11% year to date. Investors are expecting QE3 and further stimulus to support the economy. And, if you look at the recent jobs data, that was encouraging. And the housing market, I think, is picking up a little bit. In fact, anecdotally, I'm finding that for the first time in a number of years, sellers are getting a number of bids for their homes and the buyers are getting outbid. So that's a good sign. And I think Ben Bernanke has also signaled that if the economy does slip into another recession or, things look grim again, he is willing to stand by, and that provides a safety net for the economy. And I think that's sort of somewhat reassuring for investors.
Well, what about India, Punita? What are the U.S.-related risks for India?
Well, Tanvi, all markets are highly correlated, and it depends on whether we are in a risk-on environment or a risk-off environment. And so therefore, whatever happens in the U.S. economy and markets does have a direct impact on India and emerging markets. Now, how India does and whether India gets allocations in emerging markets in terms of being underweight or overweight depends on the inflation in India, the growth in India, and also policy reform. So in that sense, there is a direct impact on India, but India also has to focus on its own issues. But, the longer-term situation in India is actually better than what we see in the U.S. Globally, however, people are still investing in dividend yield stocks as a safe play, and also in fixed income because they expect interest rates to further come down. So I think in light of the fact that the risk on trade hasn't really picked up dramatically, I think India will still take time to receive a lot of flows. That's my view. With that, we wrap up this edition of the show. We will be back next week with insights from other thought leaders on the crisis in the Eurozone and what that means for India. Thanks for watching, and we welcome your feedback.